Good morning. Welcome to Darden Wealth Group's January 2020 market update. We've called it Empowering Confidence as we hope after you get done listening today, you will feel empowered. My name is Andrea Darden, the CEO of Darden Wealth Group. With me today, I have Dave McNeely, our portfolio manager. Dave holds a CFA or Certified Financial Analyst and CIMA or Certified Investment Management Analyst certifications. Previous to joining us at DWG, Dave worked for SunTrust Bank in wealth management for 14 years as a portfolio manager. I also have Mark Minder with me. He is our VP of Retirement Plans and Benefits. Mark will go over the highlights of the Secure Act. Mark has his MBA in Finance and his RFC, Registered Financial Consultant certification. Mark has 24 years of experience in retirement plans, including working for TIAA-CREF with the University of Michigan and other notable schools. This video, along with others, will be posted on our website. Without further ado, Dave McNeely.
Thank you, Andrea. I'll start by giving a brief background of myself. Like Andrea said, I worked for SunTrust Investment Services for 14 years in their private wealth management division as a portfolio manager for wealthy clients. I am a CFA charter holder and received my Bachelor in Finance from Indiana State and MBA from the University of Florida. With that said, let's dive into the agenda for today. We'll be covering 2019 returns, provide an economic summary, and provide some insight into what we see for 2020. Then Mark will delve into the Secure Act. The first quarter of the year continued the rebound which started on Christmas Eve 2018. However, recessionary concerns began to emerge in the second quarter, slowing the momentum. Q3 was a continuation from Q2, with economic data showing a slowing economy resulting in the Fed stepping in with its first of 3 rate cuts at the beginning of August. As data improved and the Fed paused rate cuts, the economic outlook improved and the market took off again. We see the NASDAQ 100, the 100 largest companies traded on the NASDAQ, outpaced all indexes. The S&P 500 trailed by nearly 9%. Interestingly, the returns from Apple and Microsoft combined added nearly 15% to the total return for the S&P 500. The top 5 stocks for the year were Advanced Micro Devices up 148%, Lam Research up 115%, Target up 94%, Chipotle up 94%, and Corvo up 91%. This next graphic includes some additional information from international, emerging, commodity, real estate, and fixed income markets. U.S. equity markets have performed exceptionally better than international and emerging markets over the 1, 3, and 5-year time period. Of note is the performance of commodities this year given the relatively poor performance over the longer term. Fixed income also performed well this year. Fixed income did not have high expectations for the year, as most expected interest rates to climb higher, causing bond prices to fall. This opposite occurred, and we had a good year in bonds. The broad U.S. aggregate index returned 8.72%. As a result of the move in interest rates in 2019, what we encountered coming into 2020, however, were low rates across most fixed income sectors. Our feeling is interest rates will remain low for a longer period of time, and we will position portfolios accordingly. A second look at the fixed income sector returns over the previous 15 years. This quilt shows that from year to year, any sector of the fixed income market is capable of leading, which is why our philosophy is not to guess which will perform better, but rather hold a portfolio which is representative of the gray asset allocation box and black line. A diversified allocation will help be a ballast for the portfolio during turbulent times in the equity market. Another quilt depicting asset class returns along with an asset allocation portfolio comprised of 55% equity and 45% fixed income. The asset allocation portfolio is highly symbolic of the type of portfolio we manage for many of you and provides a more stable return experience. Let's turn our attention to the economy. I wanted to bring back a graphic similar to the one I utilized in my October quarterly update. The visual compares 12 economic indicators as of December 31st to previous recessions. As is evident from a simple comparison, the state of our current economy is significantly better overall than previous recessionary periods. The headlines we're receiving indicate this as well. The consumer remains strong and the job market is highly competitive. Unemployment claims and the unemployment rate remain below historic averages. While fears of recession have subsided and are likely a non-factor in the first half of the year, we feel the Fed will be accommodative in an effort to keep the growth engine going. Any concern of a slowdown or recession will likely reemerge in the second half and possibly not until 2021. Let's take a look at the 2020 market outlook. Looking at 2020, we see these topics driving the market, and I'll touch on the U.S. presidential agenda, sentiment, volatility, as well as valuations. A hot topic over the past few months has been the presidential election and market activity. This graphic depicts the prior 8 election years with the intra-year loss and eventual annual return for the S&P 500. Notably, each year there was a drawdown of at least 6%. 2000 and 2008 were the only 2 years in which the market returned a negative number. If you recall, both years had outside events creating significant volatility in the markets. In 2000, we were going through the tech bubble bursting, while in 2008, the housing market collapsed. These outside events were the likeliest cause of drawdown, not the election. At this point in the election process, we do not have a clear picture of President Trump's agenda, nor do we know who the Democratic candidate will be. Voter turnout will ultimately decide who wins. If consumer confidence is any indicator, the data depicted in the graph shows the results of a Pew Research report. We see the euphoria Republicans experienced when Trump was elected versus the prior 8 years under Obama. Surprisingly, Democratic confidence, while increasing during the Obama presidency, has only moderately declined under Trump. We feel if Republicans wish to continue experiencing this euphoric state, they'll turn out in big numbers. The opposite can be said for Democrats. They'll turn out to reverse the course. As for valuation, at current levels, just under a PE of 20, the market is slightly overvalued based on historical levels. We believe with an accommodative Fed, the market can remain at higher levels. Additionally, if the economy remains strong, it will support the elevated PE we are currently experiencing. However, at some point, there will be a reversion to the mean. And moving on to volatility, we have not experienced significant market volatility, save for a couple spikes in late 2017 and 2018. Low volatility can lead to complacency among investors, believing the market will only continue to go higher. This can lead to overvaluation in the market. Exogenous shocks to the market tend to be the leading cause for prior spikes. We remain vigilant in seeking opportunities during any prolonged volatility spikes. This next slide shows a timely piece from the Dow Jones market data, which shows the S&P 500 and how it has reacted to prior epidemics. In only one case has the S&P 500 been negative 6 months following the declared end of an epidemic. We do believe that the headlines surrounding the current coronavirus will dominate and can cause volatility, but we are not concerned about the long-term impact and feel that there could be potential opportunities created. And finally, the final slide is one of my favorites and depicts the S&P 500 over the past 40 years. It shows the annual returns along with the intra-year declines experienced in each year. The average drop over this time frame is 13.8%. Given a pullback of some degree in each year, the market has ended positive 75% of the time. What this tells us is that the market will likely have some degree of volatility, the extent of which is not known beforehand. Our responsibility is to try to take advantage of these opportunities as often as possible. With that, I'll turn it over to Mark to discuss the Secure Act.
Thank you, Dave. I'm going to discuss the Setting Every Community Up for Retirement Enhancement Act, also commonly become as the Secure Act. One of the key questions we're getting from our clients is required minimum distributions, also known as RMDs. The old law was once you turn 70 and a half, you must start taking distributions from your various retirement plans. Starting in 2020, an individual who turns 72 this year or later does not have to take their RMDs until that date. If you've turned 70 and a half in 2019, you must continue under the old regulations and start your RMDs. This is one of the key differences. So once again, if you are not 70 and a half in 2020 or later, we don't have to worry about it until you're 72. One of the other rules that is becoming greater influence is what's called the stretch IRA. Under the old rules, a beneficiary could extend their distributions when they inherit an IRA or other retirement plans over their life expectancy. Starting in 2020, there is now a 10-year rule for distributions. This is in place for only what we consider non-eligible designated beneficiaries. Non-eligible designated beneficiaries must distribute the account within 10 years. Under this regulation, though, it doesn't dictate when you take it in the 10 years as long as the account has been distributed within 10 years. This allows for a lot of unique planning as you go through this process as an inheritance. The rule doesn't apply to the following beneficiaries. So if you're a spouse, the money moves over to your account and is thus your account. If you're qualified as a disabled beneficiary or chronically ill, the 10-year rule does not apply. Individuals that are beneficiaries that are not 10 years older than the deceased, the rule does not apply. For minor children, if minor children is listed as a beneficiary, they can take it out over their life expectancy until they reach the age of majority. Once they hit the age of majority, the 10-year rule then steps in. Great example of that is a child is listed as age 5. Their distribution would be based on their life expectancy until they reach age 18 or 21. And then the 10-year rule would start for them. One of the key things I see that is a great opportunity for a lot of business owners within this act is the small business retirement plans. Starting this year, they are giving a credit for all plans that are new. This is for companies that have employees of 100 employees or less that earn more than $5,000. The tax credit is up for 3 years, and it is $500 or the lesser of $250 per participant in the plan, minus any highly compensated employees, or $5,000, whichever is the less. I have seen instances on new plans where there is savings of a tax credit of up to $3,000 to $4,000 per plan over 3 years. This is a great way to offset any starting costs for a plan and to motivate the employer to sponsor a plan for their employees. Also, for small business retirement plans starting in this year, January, if you create auto enrollment, and this is for new plans or existing plans, there's an additional $500 credit that is available for you. So this, once again, it can increase the credit you maintain as an employer as we develop a retirement plan for you. So if we start a new retirement plan, a great way to think about that, you have 15 employees we start doing that, we can add how much that would be on the maximum credit for you. Plus, if we create an auto enrollment, that's an additional $500 credit. With auto enrollment, your employees can opt out. What we have seen in the industry is typically a 90 to 95% adoption rate by employees on being automatically enrolled into the retirement plan for them. One of the things I think long term that is going to be an impact is they're extending the eligibility for long term part time employees. We hear a lot of, there is a lot of people that work part time jobs that don't qualify for retirement savings. This new rule actually starts January 1st, 2021. So what this means is for an employee must have worked at least 500 hours. The old rule was 1,000 hours, and it had to be for the previous consecutive 3 years. Now, the one caveat for this is since this rule starts in 2021, that's when the clock starts ticking. So for your long-term part-time employee, the 500 hours plus 3 consecutive years actually starts in 2021. So this is the earliest they would be eligible to enroll into the retirement plan would actually be 2024. For an employer, this does give some planning capabilities so that you can plan on how to build this plan to make it the strongest for all of your employees. As I went through this act, there's many details. Some of the things I think that are going to come up or could be of interest to many people. Under the previous Tax Reform Act, children's tax was taxed at their tax level. Well, that now has been removed and it reverts back to the parent's marginal tax rate. 529 plans, they have expanded access to that. They've extended it so more apprenticeship programs can be covered by 529s. One interesting caveat is money that is in a 529 can be used for student loans. There is a maximum of up to $10,000 that can be distributed from the 529 for student loans. Also, for those of our clients that are in the higher education field, if you're in a non-tuition fellowship program or you receive stipend payments that are considered taxable income, they are now actually can be treated as compensation for purposes and contributions within your IRA. This can help those people that are starting their careers through the university or research programs and saving for retirement. Also, I think one of the things that's interesting is for those families that are planning birth or adoptions, they are allowing a qualified distribution from your retirement plan of $5,000 after the event has happened. Now, this is $5,000 per person within the family. So you have a couple, both people can take $5,000 out of their retirement plan. They still pay taxes, but it is not an early withdrawal penalty. The only stipulation is after it takes place, not before. Thank you for your time.
Thank you, Dave. Thank you, Mark. If you have any questions, please feel free to contact us either via the email or at the phone number at the bottom of the slides. Have a great day.